The top three things in my notebook this morning: number one is the euro. It really could be number 1, 2, and 3 could be the euro, but number 1 is the euro. Number 2 is the commodities index, CRB index. Number 3 is volatility in the U.S. equity market. So first on the euro, again, absolutely burnt to a crisp. So what was support for the euro, 115 versus the U.S. dollar, is now resistance with 112 and 111. I think it ticked down to 111 this morning. So again, in European burning currency terms, that puts certain European equity markets up, what, 7 to 8% for the year to date. So again, if you really want to tell yourself that you're buying stock markets because you love economies, I mean, you certainly wouldn't have bought Europe, but buying Europe is where all the performance is all of a sudden at. Again, this has happened in Japan. It's happened in many, many countries where they devalue the currency so that you get, on a currency-adjusted basis, asset price inflation. But away from that, what you really get, which is point number 2, is more deflation. So again, friendly reminder on how this works. As the euro goes down, the dollar goes up. As the dollar goes up, commodities go down. As commodities go down, oil go down, energy stocks go down, energy firings in Texas and the Dakotas go up, you get more deflation. So again, the Europeans and the Japanese getting more and more cowbell, or getting more panicky, and again, that would be a panic move yesterday to provide more cowbell than I certainly thought he had in him, is only going to perpetuate more deflation. So the CRB index yesterday actually closed down 1.3% on the day. Now again, if he's trying to get inflation, he certainly didn't get it there. He's not getting it in the bond market. Bond yields, sovereign bond yields, continue to hit new lows. Again, that's signaling more and more deflation. So again, we'd remind you of that. Now finally on the VIX, what's born out of all this, again, when you get more deflation, you get more volatility. So again, there's going to be a lot more volatility across asset classes and subcomponents of asset classes when you think about this. So again, if you look at the bond market, junk versus the long bond, very volatile situation for the junk debt market, particularly those that are related to energy prices. And then if you just look at subsector ETF exposures, and again, in the S&P 500 itself, energy stocks were down on the day yesterday versus consumer staple stocks hitting new year-to-date highs. So again, lots of volatility, lots to do on both the long and the short side, which continues to at least tell me it's one of the most exciting long-short periods of having good ideas on both sides of the ledger that I can remember. And those are your top three things. We're going to have our market marathon next week, January the 27th. Again, I'm going to have some of my friends like Jim Rickards on, who's going to talk about things that are just exploding to the upside right now, like gold. We're going to talk about everything that we talk about, but we're going to talk about it throughout the day. And again, there's a lot to talk about in non-advertising central planning fan club terms, which is, of course, what we're going to do.